you can see, in a sense, what's in it for the ultimate corporate borrowers. Notice these are both corporations, they're not banks. But there's an incentive here now for a swap dealer. There's 35 basis points. Right? In this little example, we gave 25 of them to AA and 10 of them to BBB. But there's 35 of them. Okay? So there's an incentive here for a dealer to go inside that and say, I'll set this whole thing up, and all I ask is 2 of these points for myself. Okay? What is the bid-ask spread here, quoted here? You can see that at 1 year, it's 0.32 is the bid, and the ask is 0.35. So that's 3 basis points. Okay? And the 2-year, it's also 3 basis points. And if we go all the way out to 30-year, it's also 3 basis points. So that seems to be kind of the standard thing right now. There's 3 basis points there that is dealer spread profit. And where is the dealer in this picture? Okay. We are talking about a world here where we have AA. Let me just clean this up. On one side, okay, they're short a swap, okay, and we have BBB on the other side, and they're long a swap, okay. And now we're introducing an investment bank in the middle. Which is doing a swap with AAA, okay, and doing another swap, AA, another swap with BBB, okay. And there's a spread there that they're harvesting. So they're using their own balance sheet to stand in between the short and the long side. And some of these swaps last for a long time. So there's a swap book that an investment bank will be running, which I'm showing here as matched book. So that they've made equal and opposite promises to 2 different parties, okay, but for different prices. Okay, and that's the profit for them, is that spread, the bid-ask spread between these swaps. This is where prices come from. This sort of, remember when I talked about indirect finance and direct finance, okay? There's interest rate swaps is sort of where forward interest rates come from, all the way down the yield curve. And that swap yield curve that I was showing you there comes from this sort of activity. It comes from dealers quoting a bid-ask spread, and then AA and BBB saying, well, what do I want to do? Am I a buyer or a seller? And you go to the dealer, and you don't have to worry about somebody being on the other side. That's the dealer's problem. And the dealer is quoting prices, and it's also maybe not always having matched book, and sometimes it's trying to hedge, and it will hedge using treasuries, possibly, using forward markets, using futures markets. So it's a dealer. The investment bank is being a dealer here. A dealer in the swap market. The interest rate swap market. Okay, I thought I saw, did you have a?
So the only risk you have is as like the higher rated company is like if like the fluctuations in LIBOR, is that the only?
Fluctuations in LIBOR are not your problem. That's what the swap takes care of. What I was saying is fluctuations in the credit rating or the credit spread could be a problem in the sense that it causes a problem for BBB because the BBB's hedge is against market fluctuations, LIBOR, okay? Not against changes in the spread over LIBOR when it has to roll this funding. That BBB, so let's just go through this again. What's supposed to be happening here is that usually the fixed rate is higher than the flexible rate. So typically what's happening is that BBB is paying to AA sort of the difference between 550 and the current LIBOR rate. They're paying this way. The cash flows are going this way during the life of the swap. They're willing to do that because it lets them lock in this long-term funding. So they're paying some to AA, and they're paying some to their original loan here. Okay, they're paying their banker, and but that 6-month loan has to get renewed in 6 months. Okay? And if they can't renew that, they're not going to be able to continue paying here. They're going to be in financial crisis. Okay? So there is exposure to the potential worsening of the credit rating. And when you think of it, that's exactly why the market was only willing to lend to them for 6 months, because the market was saying, I'm not sure you're going to be around 6 months from now, and I would just like to have another chance anyway to say, I would like my money back, thank you very much. Or to change the rate, this is riskier or whatever. That's exactly why they couldn't borrow at the long rate, okay? And, but so that there is that exposure that AAA has. Now, by putting an investment bank in between, right, you've now improved the situation, because AA's exposure is now to Goldman Sachs, okay, not to BBB. Okay, BBB's exposure is being held by Goldman Sachs, and they may be creating a whole portfolio of these swaps with low-rated companies, all on this side, okay? Because that's how it's going to work, right? They're going to have high-rated companies on this side and low-rated companies on this side. And once you have a portfolio, there's diversification and all of that. And so this is essentially creating a diversified bond portfolio, okay? Is what they're doing, but in the swap space, so that it doesn't take up any balance sheet room, right? It's just in the but it is basically corporate bonds. That's what these are, Eurobonds. Really, I think maybe one of the most important things to come away from this is appreciating. We're used to thinking about dealers dealing in treasury bills or something like that. Okay, that's what determines the yield curve. Okay, is dealers, but there are dealers dealing essentially in corporate bonds. But that's what they're doing. This interest rate swap market is completely analogous to the government securities dealer market. This is where those prices come from. Okay, is from the swap market. Everything that we read, when I was from this 1952. 1952 was all about the Fed is influencing the shape of the yield curve by messing with the short end. Okay, well, the Fed is also influencing the shape of the swap curve. Okay, because these curves trade off of each other, okay? And the dealers are in the same business. Government security, in fact, often they're the same people. They're running an interest rate swap book, and they're also running a government securities dealer operation. And they're using one to hedge the other, possibly. They're long one, short the other, and so that can also net out. So this is what's going on. This is where the prices come from in capital markets, okay? Are these dealers making markets, quoting bid-ask spreads. And once you see this, you realize that this is a lot closer to the money market than you thought, okay? That because they're dealers, okay? So they're highly leveraged, they're financing themselves in the money market, and that helps to understand why prices are volatile as they are.